Good morning, everyone. This is Teddy Kekstadt from Forex Trading Unlocked, and we're here with a Wednesday morning Forex market breakdown for you, sponsored by Nadex. And okay, we can just get there we go. Oops, here comes our Nadex disclaimer, which just lets you know that this webinar is for illustrative purposes. And just wanted to take care of that first little formality. And now let's jump into our economic calendar and see what's relevant for the next few days of the rest of the trading week. So we have for US dollar, the import price index. For the euro, we have German GDP, EU GDP, and French CPI, all of which will definitely have a little bit of influence on the euro today. And then we have the British pound, GBP rather, retail price index and PPI. So are these going to stir up the European currencies and finally get them to bust out of their range? Well, we're going to have to see what happens with that today, won't we? And then tomorrow we have the Australian employment, which is going to be a big number for them. For US dollar, we have the industrial production, and we also have retail sales. Two things that are going to be probably watched very closely as far as the US dollar. So those two numbers, when they come out, a lot of other currencies may be pretty quiet going into the US market opening and the release of those numbers. And then we also have on Friday the US dollar housing starts, which is sometimes it's a big number, sometimes it's a medium range number. I think that as we head into the middle of third quarter here, that this number is going to be very key as we start to move into the fall, and especially as we start to head into election season, because we know that the real estate market will definitely be one of the topics probably coming up in the over the course of next year with the new election. So with that, let's go on to our first chart. So for euro US dollar, we've been looking at this market for quite some time, and is one thing we always remind everyone about is that the euro US dollar, even though on the chart looks like it has some nice little movement and swing trades, if you look at the ranges, they're very, very, very tight. Recently, the trade, like if you see like over the past week, the ranges haven't been more than basically $0.50 to 70 pips. So that's not much of a range for any type of swing traders. Obviously, intraday traders must be getting chewed up, I would think. Range traders and options traders, definitely this is a very, very good environment right now, because the pivots are working very well as the fact that there's so much neutralizing impacts by economic numbers, and then also you have, like, for instance, the Brexit. So euro US dollar is impacted by Brexit, which we are coming close to that September 1st deadline, and then the October 31st hard Brexit, whatever. We'll see what happens. Right now, it seems like that's all going south. So for the euro US dollar, we had some really negative numbers that have been setting the tone for a negative trend in the EU economy. Moving forward, production numbers for the past couple of weeks have been very, very bad for Germany as well as other countries in the EU. We have also some Italian elections that are coming up in the forefront. We have those numbers that we just spoke about as far as the for France and for Germany. So we have to see how that impacts today's trading. So far, as you can see, this chart was just copied right before this webinar began. The range today has been very, 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 very tight. So this chop zone right here is meant as kind of a guide for where I think we're going to see the market pretty much drift into over the next, definitely into the rest of this week and moving into next week. I think that this $1.1265 is going to be pretty much your cap, just above these highs here. This would be a critical pivot to get above. A breach of this level would definitely show that there is some positive things going on with the euro and in the eurozone. And that's the one thing that's hard to grasp of, is that except for one number in the past week, almost everything has come out very negative. So right now, it's really hard to see how any bullish momentum, if they do get above here, how much is there really to the upside? I would say maybe about a $1.13.5. So you're looking at maybe a full dollar above this would be the extent of any type of inflated rally. I think we pretty much would run out of gas there. However, as you see right now, it's having trouble just getting above this 111.85, 81 pivot band right here. So this is both a weekly, daily, and there's also another fib number that comes right into where the market's trading at right now. So we have this downward sloping resistance right here containing this little wedging formation that we have here. Is it going to pop? It's likely that we're probably by attrition going to move sideways and take out this downward sloping resistance. Now, if the bears can start to really get something going, and what would do that? It would mean you're probably going to have to see a bunch of US dollar strength. And now that's the funny thing is right now is that the US dollar is becoming a reluctant bull. It's because of we're in the wake of all the central bank actions that have occurred over the past couple weeks. And we know that moving forward, we definitely were waiting on some more to happen, especially coming out of the EU. And it will be a reflection of their how they are interpreting their economic numbers that have come out also. So I think that it's probably going to be another week or two before you're going to see any type of ECB actions, which is going to contain everything within this $12.65 to pretty much $1.11, which leaves you a little over $1.50 of a range that the market's going to be chopping around in. And if you look at this, it's not like a rocket science to like think that this could occur, because if you look at this critical pivots that I talked about here, where we have this 111.85, 81 pivot band here, just above it, up towards where our breakout pivot is. This has been where a bulk of the trading has occurred since May. And then below this pivot, this is where we had spikes of fairly decent support that comes in quickly, not support that drags out, can stay in this area here. So I think that it probably would be contained by this 111.06 area. Only a failure from here where I see us trying to make a run for this low over here. If the Euro-US dollar trends that deep back into these lows, that probably means that there's a lot of really, really bad numbers that would be coming out over the next week and a half that would help to propel the bearish momentum. As far as dollar strength is concerned, there's too many other factors that have it neutralizing. So it's kind of funny, as we've had some pretty decent swings in the Euro-US dollar over the course of the summer. I mean, the ranges have been very tight. There hasn't been much risk exposure. However, there have been some decent moves and swings in this area up until the last week and a half. So after we had this nice little turn, we had this one little bullish move here. And then look what happened. We had all these central banks, and you would think that in the wake of all this that we would start to set a trend one way or the other with this market. Not happening. It's just not happening. So I think you're going to see more of the same. And that being said, I'd be very careful for any outright directional traders, as far as if you're going to look to be bullish, I think you look to buy into weakness, and I think you look to sell into strength if you're a bear. Just because I don't think you're going to see much activity. I mean, just by the ranges, if you see how this traded, we had this big gush bullish move here, followed by this where we set the recent high. So this was a turning point day, signaled that, not necessarily a change in trend. And then within always, that has contained the range up until the last couple sessions, with the bulk of trading being right around where that market had settled after this rally. So that being said, it's almost like there's a median line that it's kind of like an EKG, how it goes flat before you get a spike one way or the other. And I think that's pretty much what we settled into, and that's why I have this chop zone here. This is where I think you're going to be contained. I would be very, very careful anywhere above this area right here. Like I said, once again, 112.65, and definitely I don't think I think you're going to be exhausted before you get down towards this low over here. So now let's go look at the British pound US dollar, because we're on that side of the pond right now. So we're starting out in Europe, and then we're going to make our way over to Asia to try and get a grasp of what's going on with the dollar. Okay, so this is a whole nother story. The British pound has its own woes. I think that is there correction in sight. It's actually kind of set up for that right now. The sentiment by all the pundits and everything is that the pound is just going to continue to erode versus the dollar. I buy that scenario. I think that that's most likely that what's going to happen is that this bearish trend is going to continue over the next couple months, at least until the middle of September. And then depending how the tone is between the UK and the EU, I think that that would maybe set a balancing. When the market was here over the summer, rounding out here before it has collapsed after these central bank actions, and after Boris got signed into the prime minister spot, this market fell apart. I thought we were looking to round out a bottom and maybe start to see some kind of progressive at least coming to the table. However, since then it's been actually, it seems, I think things have gone more south than they were before Boris Johnson took over as prime minister of the UK. So this target zone range here, not that bullish. However, I think that there's a good chance that how this range that had been set for the past week and a half, it lowered last Friday, and then it kind of took a little bit of a test of it on Sunday night, Monday, and as you can see, it's been pretty much contained. This little Monday here was a kind of a weak buy signal, nothing major, but especially since this trend is something I would highly suggest you don't try and catch a falling knife and be mindful of being long. So I think that if you're an aggressive long, you can use Monday's low just beyond that somewhere as a risk level. However, what is your potential to the upside? Well, that's a good question. We could obviously spark a correction and get all the way up towards this 125.58 pivot, which that's the only way I see any type of major bullish action coming into this market. And I really don't think that's going to happen. I think this downward sloping resistance here should contain the trend at least, well, probably going into, look, here's October 1st. I think that that's very likely that this market is going to continue to drift lower, but not necessarily so severely. We see how basically for the last now almost 2 weeks, the British pound US dollar has gone sideways. The ranges are not very tight, even though Friday it lowered the range. I would not going to say that it's bottoming, but I think that by attrition, you're going to start to see it just chop around and move towards this downward sloping resistance, where it may still test support a little bit, but I don't think you're going to get very much. As you can see that as it's been making these lows, it recoils right back into a very tight trade. So the irony of it all is that the UK has actually had a couple economic numbers over the past couple of weeks that have benefited their economy, or at least show some not necessarily signs of growth or any type of major long-term bullishness or anything, but however, I think it's because they keep downplaying the UK so much that since the expectations are so overblown, it's pretty easy for the UK to beat expectations. Not that that's necessarily bullish, but that I think is the case of what's going on right now. So that being said, I think that your target range, once again, this is where you have to look for possibly any type of upside action, and it's most likely going to be contained. This $23.76 area is going to be very tough to get above, at which point you're going to have to first breach this downward sloping resistance at the same point. If there's a breach of this 123.76 area, maybe then you can see how there was this little range here between these two pivots. Maybe then we get a challenge of 125.58 on any type of blow-off move. And you can, the pound definitely can have some very violent trending days. Unlike most currencies, that this one, when it pops, it really, really pops. So you don't want to get in front of that freight train. So an upside correction, if there was some sort of US dollar weakness that really prevailed, some kind of prevailing headwind, then that would probably readjust the pound US dollar. And when I say readjust, it means because of major dollar weakness. That scenario would pan out where we could see the pound rally up to challenge this 125.58 area and maybe even get back into this zone where it had been for most of the summer, which I thought that, I mean, this is almost a direct opposite of where I thought we would be. This break here and sliding down into this, I thought would be probably more or less not quite as severe as a rally as this was a break, but I thought we'd be trading somewhere between 127 and 128 by now, or at least having had a spike up to there. Not so. That is not the case. So that is the prevailing winds with this trend. So it's kind of funny that we look at the first two biggest pairs versus the US dollar, and one, the euro US dollar, as bearish as that one seems to be, it can't seem to break out of its sideways trend. It just swings within that tight few dollar range. Whereas the pound US dollar, on the other hand, this thing has been just sliding and sliding and sliding and trending lower and trending lower. So any major bears in this currency pair have done very, very well over the past few months, especially because there hasn't been much of a recoil except for this one move in June with this correction here. How much heat did you ever take on any short position if you already had a lead on it, especially once you took out a swing low? Now that's the thing I'd be very careful also as far as being shorts. I would look to sell into strength before I would look to try and be jumping in on the trend right now. It's too tough right here. You could very easily be selling it in the hole. And then also, like I said, it's very likely that if we do have any move to the upside, it's going to start to be like a very violent, quick trending move. So something like where it turns like this one here, you're going to see a 1, 2, 3, 4, 5 day or more rally. And that's the kind of corrective move I think you would see in this in the pound US dollar cross. And that's where something like the target range here I could see us, if we take a little test of support, and if we really can't take out these lows by very much, we probably would see a nice little buying move that would send us back up into this target range here. So once again, we have those economic numbers to key off of. And the main thing is that even though there was only the one number for there's only a couple numbers for the pound, really. The EU has more that are really impacting that relationship this week. Those are going to be very key because of the relationship between the pound and the euro. So that's not a cross that we're going to go into right now, but the spread between that and the trend in that market has it looked like it was overdone a couple of weeks ago, and then all of a sudden it resumed in a big way. So the pound as a whole has been trending in multiple currency crosses in just one direction for a very long time now, for months at a time, even upwards of over a year now in some major currencies. So eventually there's going to be a turn in this market. Am I going to try and call that? Absolutely not. The bearish strength is totally there right now. However, one thing that could lift the pound would be some significant negative numbers coming out of the EU, because the more that the EU has to focus on their economy, and especially any type of preemptive lifting moves, such as the QE measures that we know are already in place and they're planned to be launched again. As they start to implement these things, it may have some bearing on kind of pushing their cards as far as what they have to do in relation to Brexit. That's going to be obviously a sloppy topic going into the fall, and that's when I think we're going to start to see the volatility. So where we see this tight range trading that happened over basically since August has begun, except for the one sell-off on Friday. I don't think we're going to see that anymore. The dog days of summer, I think, are winding down for the pound, and either it's going to extend itself lower, or I think it's more likely, that's why I have this target range, is that I think it's more in a digestive phase where it's going to, just by attrition, sideways test resistance a little bit, kind of nudge its way in, fall off of this downward sloping resistance, and that's when we're going to see the next slide as we head into the Brexit, hard Brexit or non-Brexit or whatever is going to happen. So the reality is that the EU does not want to give the UK back its sovereignty. Ultimately, they refuse to let go. And is that going to, can they do that? Will they do that? I don't know, but I think it will come to a head in a big way, especially if there is no Brexit come October 31st, 2020, I think is going to become a very tumultuous geopolitical year. So, and what will that mean for currencies? What will that mean for the dollar? I don't know, but I think we're looking at seeing some very, very good trading opportunities. So right now, speaking of trading opportunities, I would look for selling into this 123.76 area if you're a bear, and only if you get a rally up above 125.58 would I say the bears are definitely, all cards are off the table, or everything's off the table then. But as far as the bull, that's not something where I'd say you can look around just below the low that was set this week on Monday and use a very tight stop. I think really what you're looking at more right now is for range trade conditions to slightly higher. So that being said, I think that you have lots of option capabilities where you can trade these pivots without looking for any excessive bearish momentum, at least in the short run going into the rest of this week, with I think the odds of possibly seeing a little challenge of resistance into this target range. That might be where we have a good shot, especially as we come into all these numbers that pan out today as we absorb them from Europe, and then also the ones that come into impact us on Thursday and Friday. So with that, let's jump over to the other side of the planet, all the way around the world, to Australia. Now here, choppy range trade, look at that. Yeah, this has been a blender. So we set that low last week on a stamp, and then that was a short term, not necessarily buy signal or reversal, but definitely a change in, at least a pause for the trend, which it did. And then what a pause it had, right? It can't make up its mind here. It has a little follow through to the upside on this recoil, and then falls back to right around where it closed. And here we have today, this chart was taken right before this webinar. The market today is taking out yesterday's low, took out its pressing support down here, and it's right here at the bottom of our choppy range trade band. This is the choppy range trade band. This is crazy. We have numbers in China that this is where we're at with this currency. It's being pulled from everywhere. China had some very bad numbers that came out yesterday, and it both retail and production wise. So that anything that happens in China obviously impacts the Australian dollar because they're a major trading partner. So that's one issue right there. Then you also have what's going on between Japan and South Korea. There's a new trade war that's beginning there, and then there's also tensions because they have lots of tensions to begin with. There's all kinds of stuff, lots of strife that seems to be, I wouldn't say boiling over, but a pot that probably had been on low is now starting to simmer. So that's going to influence the yen trade, which is also going to influence the Australian dollar. So Australian dollar weakness against the dollar. Here's the one thing we know. As far as an interest rate tone, we know that the Royal Bank of Australia did not cut rates a week ago, which was kind of unexpected. Everyone thought that they were most likely going to. They didn't. Not that they're not going to. I think that because of all the stuff that was going on with all of the central banks that were acting, they wanted to see what was going to happen to their currency first, and then reevaluate what's going to happen. That's my opinion why they did what they did. So I think that they are still going to cut rates. So I think it's going to be very hard to get a long-term bullish outlook for the Australian dollar US dollar cross, just because we know that the US dollar component right here is going to be static for most likely the next 3 months. The Fed, when they did the rate cuts, said that they were most likely not going to cut rates again for quite some time, and that their move should be sufficient. The odds of, before they cut the rate, of having a second rate cut had dropped from something like 75% down to like less than 20% in the course of a few weeks leading up into that last Fed meeting when they cut the rate. And now there's a lot of pundits that are starting to say that economic numbers and slow down this and blah, blah, that the U.S. Fed is going to have to cut rates again soon. I don't think so. That's ridiculous. We have stock market on highs. They already did a preemptive bullet. We know that other central banks are scrambling towards negative interest rates. We know especially the Bank of Japan, they ain't doing anything at all. So they drew a line in the sand. They've been here. They've been through this bad show before. So the question is, who's going to follow the examples of history, and who is going to panic and continue to basically self-perpetuate themselves into a bearish type of environment? So that being said, I don't think you're going to see very much beyond this 68.32, 68.29 pivot band right here. This is both a Fibonacci, obviously a swing point, and there's also some weekly and monthly levels that all come into right around within a few pips of this level. So that is definitely, I think, a very, very tight containment resistance area. You can see that the highs here were unable to breach that spot. If we get a pop above here, then I think you're going to see a nice little potential spike up towards the 68.76 area with any overdone rally coming up probably short of the 69.10 to 69.24 area. This is a critical area as well. Besides having fib and monthly, there's a whole bunch of other target reasons where a close and a sustained trade above this area here, that's very positive for the Australian dollar, US dollar. The only thing I could think of that would perpetuate a rally up to this here and then even get it to maybe it's a 69.92, challenging this downward sloping resistance. A rally up to here would have to be because of US dollar weakness. So right now, the US dollar is the most reluctant bull I've ever seen. Not that the US dollar needs to fall apart or collapse or become a bear. It's just that in my trading career, I've seen the US government, the US Fed, and a whole bunch of other geopolitical economic things influence the dollar, where no matter how they tried to support the dollar, they couldn't do it. Good economy, bad economy, cutting rates, raising rates, what have you. And now we live in an environment where by default the US dollar is strong because everyone's trying to crash their own currencies. So what does that tell you? That just tells me that it's hard to sustain any rally. So that's why I think you're going to have a cap in this area. Now, as far as falling below here, that's tough too. Like right now, we have the market on its lows. There's been every reason in the world to buy and sell the Australian dollar, US dollar since it stamped this low last week. And look at what happened. It has just boom, boom, boom. So intraday swing traders, if they're on the right side, must have had a really good past, like I would say a week and a half. But that's, I would say, only if you were on the right side. Outside of that, I think that you had to have gotten chopped up, especially being a bull. You had to be chopped up for sure. And even if you were selling it, if you were a week short, you had to just get scrambled up in this, especially towards this toppy area here. So for pivots here, look for this, I would say the 68.32 area as a cap. So if you're, I would say, an aggressive short, then you would want to definitely be trading against this one. Now, I would be very careful if you're a bear. I keep your stops tight. Now, you know that if we take out this little high from a few sessions ago, odds are we're going to touch this little area here. It's probably going to be a lot of stops there, and you can see a spike that doesn't last very long. It may even shoot up towards the 68.76 area. However, I think that the odds of any rally through here to be sustained are very unlikely. I think you'll see a pop and then you'll come back down, probably trading below this area here. So choppy range trade, is that the call for the next few sessions? I think so. I don't think you're going to see very much follow through today. There's those other numbers that are going to be very impactful for the Australian dollar. So unless whatever came out today, and also with the outlook for tomorrow's number, if it's very bearish, then I don't think you're going to really see much follow through on this move. Now, be very careful. If this Australian dollar, US dollar currency cross does fall down towards the 66.77 level, and if it does take out this low, well, that's all bets are off then. And then the bears are really going to chomp on this one. Because you saw how violently the sell-off was here. This was all because of the when we came into that 3-week period of central bank actions, this was where it caused this break. Now, this is what happened without them cutting the rate. See, that's why when I started off on this chart, I was made it a point of talking about the RBA. So since it didn't do the rate cut, it's stabilizing here. It's not bullish. This is just stabilizing here. So I think that for sure, if we take out this swing low here, that you're not that we're going to see a severe break here. And this came from just 70.5 all the way down to 66.77. So that's a pretty large sell-off without having any real dollar strength issue. I mean, the dollar was stronger in that period, but nothing to really send this market down like this. This is more indicative of what has happened with the Chinese numbers and also with New Zealand dollar also. See, that's the other thing as well. You also have the New Zealand dollar, which also impacts that trade zone. So you have, I'm not going to talk about the yuan and the Hong Kong dollar because we know the Chinese just fixed their currency again, blah, 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 and that's just not going to impact this. That's already factored in. So, but these are the points to watch out for here. Like I said, I think that this market is not going to be trending too much. I think you're going to be chopping around for the next few sessions, maybe even all the way through next week. So now this is one of the major currencies that finally has been setting a move. You know, I mean, obviously it doesn't look like a euro US dollar currency cross. It's been chopping around in only a $4 or $5 range for 6 months. And here, this is definitely giving you some opportunities. Right now, though, opportunities are kind of off the table. Right now, it's in like a digestive phase here. So for outright directional traders, I'd be very careful. I would sell into strength. I think that the odds are in your favor there. So any new swing highs, I would say, are probably winding down of an upside correction off this low. As far as buying this market, I don't even know where to tell you where to begin on that one. Definitely this low from last week, the 66.77, you don't want to be long against that. I guess if today and into tomorrow, if we can drift towards this low and we haven't taken it out, if you want to try and look for a low risk buy there, I would say you can probably buy against somewhere just below this low. However, I have to say if we take out this low, I think you're going to see a pummeling of the Australian dollar, US dollar again. And this is once again indicative of a reluctant US dollar bull. So the dollar index, if you see a really big uptick in the dollar index, then obviously any type of bullish AUD USD dollar currency cost trader, you're probably going to be on the wrong side of that move. So now let's look at the US dollar yen. This is a market that has had some nice action over the past few weeks. Everything from when the Fed cut the rate here, and then now we had all this other central bank action. Now, unlike the Australian dollar, US dollar, which we know that the RBA is most likely going to do something, the US dollar JPY here, we know that the Bank of Japan, they ain't doing anything. As far as the US Federal Reserve, they're pretty much off the table. At least we want to use that expectation going forward for the next couple of months, couple of weeks for sure at least. Stop listening to the news. And then look what happened. We had a nice little bounce yesterday. What an explosive rally. A very nice corrective move. Now, we've been trending lower for 2 weeks, so to have a nice move like that, that's a little exacerbated, I think. And then, of course, we have the sell-off that's going on today. And this is probably more profit-taking than it started, and then it was fueled by some Chinese numbers and things going on. Now, the Chinese numbers, while they're bad, and everyone's like, oh, there's a slowdown in Asia. Well, the slowdown's in China, but it's not a slowdown everywhere else, that's for sure. And who's benefiting from it? Japan is one of the countries that's benefiting from it. However, there's turmoil between Japan and South Korea. It seems like the whole world has to go back to kindergarten. We need to take all the leaders of all the countries, no matter where they are, put them all in kindergarten for a year, and then see if they can come out and then deal with things properly, because no one can seem to get along anymore. It's just like it just seems edging here, there. It's not in the United States. It's everywhere. It's everywhere. It just makes absolutely no sense. Because actually for trading, it's becoming actually kind of hard to gauge what's going to happen geopolitically, because every time you think you start to have a handle on it, just forget about it. And no one can seem to come to terms. So that being said, the US dollar yen trade sideways, at least I would say probably over the next couple sessions, to digest the Chinese movement. As well as what's going to probably happen with like I said, the Australian dollar, US dollar, probably going to be chopping around. So for major currencies, unlike the pound, which just continues to set its trend, The US dollar JPY has definitely been in a free fall for a while, and I think it's going to maintain that posture. However, in the short run, even though we are much lower today, I think that there's a good chance of taking another run at this 106.78 area. Now, a test of this would mean that we have a good, this is where we're going to get the line in the sand, I think, with bullish and bearish momentum. If we can get a rally above 106.78, then there should probably be a little follow through as this makes a newer move high up to 107.19. That, I think, would cap it if this market is going to be a short-term bear. I mean, no matter what, it's an overall long-term and intermediate-term bear. I think that the U.S. dollar is going to continue to, unlike we were talking about how the U.S. dollar is a reluctant bull, the U.S. dollar can't be anything but a bear against, I think, the U.S. dollar JPY currency cross. That's pretty much because of the interest rate variable. We know that no matter what, the Bank of Japan, they're not, who knows when they're going to touch rates again. The last thing in the world they're going to do is cut rates. That's, I don't care if we have a stock market collapse in the United States and pound it all the way back down 50% of its value over the next couple of weeks. It's not going to change anything as far as the Bank of Japan. Now, as far as the U.S. dollar, we know that the Fed, at least their transparency, which is pretty good, that they're not doing anything for a while either. So that being said, the interest rate variable, which is one component of driving currency values, that's off the table. It's set in stone. And if anything, there's going to be a lightening of the currency, which would just mean a continuing lower of this trend as well. So that being said, I think if you're a bear, you look to sell into strength, wait for a pop or make a new move high and look to sell somewhere around this 107.19 area. Now, if we could see a blow off rally, then I got this little target range here because I think that this is it. This downward sloping resistance line, I would say most likely, unless there is some reason for some major US dollar strength. Now think about this, the US dollar has been strong against most of the global currencies, especially the strong big currency crosses, except the yen. The yen has been a complete opposite trade. So with that being said, follow that trend, look to sell into weakness here or sell into strength here. And outside of that, I would be cautious with the lows. I think you're going to be more sideways right now because with tensions going on with South Korea and then also what's going on with China, I think that there's going to be nothing but a digestive range trade setting up. So pretty much how we saw the yen snake along through June and July into August before the Fed cut the rate. This target range here, or range that had been established over those 2 months, I think now it's just settling right into here. So all we did was move this down to here, look for selling into strength here as we move sideways, and we may maintain this low for the next like 2 months. Just how this low was here and lasted for this low period. That's probably what we're going to see here. So with that being said, make sure you do your homework, everybody. Always look at the markets, look at the different currency crosses so you can weigh your trades. Always have a plan and stay the course. I'm Teddy Kekstadt from Forex Trading Unlocked. And if you want to find out anything else that I got going on, you can always find us at forex-trading-unlocked.com. You can find us on Twitch, Twix, and LinkedIn. And also, if you want some good reading, and if you're an Amazon Prime member, you don't have to pay for anything. You can read my book, High Probable Japanese Candlestick Patterns, available on Kindle and Amazon. So, in fact, we just lowered the price recently, too, because to celebrate the 10-year anniversary of Forex Trading Unlocked Incorporated. With that, you folks have a really great trading day. Good luck, and use cautious, and remember to have a plan. Take care. Thanks.